In the past few months, markets have taken a sharp dip, and it's left many new investors feeling the sting. For anyone just getting started, watching investments drop can be downright unsettling. But don't panic. This video breaks down what's really happening in the market right now and shares some foundational investment principles to help keep emotions in check. It's all about understanding the bigger picture, so that instead of reacting out of fear, you can start thinking strategically about how to move forward with confidence. Let's start by breaking down why this recent market drop happened. At a high level, it all ties back to global economics and some specific changes, especially in Japan. For years, Japan's banks have had negative interest rates, meaning that people actually pay the bank to keep their money there. Naturally, people with money in Japan didn't want to pay these fees, so instead, they borrowed money at low interest rates and invested it in Western markets, particularly the US stock market. Recently, however, Japan's central bank announced they'd be raising interest rates. This meant that those who borrowed cheaply to invest in places like the S&P 500 now had more costs to pay back. To meet these obligations, many began selling off their investments, which added significant selling pressure to the market. Adding to this, the Bank of England recently lowered its base rate from 5.25% to 5%. And many expected the Federal Reserve in the US to follow suit. However, the Fed held off on reducing rates as they still had concerns about lingering inflation in the US. All of these factors combined to create the market drop seen last week. So, what can an investor do? Unfortunately, individual investors don't have the power to influence central banks or monetary policy. It's beyond their control what the central banks in Japan or the UK decide, or what the Federal Reserve does in the US. Investing inherently involves facing factors like these that are out of an investor's hands, factors that can either help investments grow or cause them to lose value. Over the long term, however, the goal is to look at the overall trajectory and see if the outcome is profitable in the end. Accepting that markets can go down and that losses are possible isn't easy. Behavioral psychology shows that loss aversion, the fear of losing money, is real. When investors see their hard-earned money shrink in value, the instinct is often to sell to avoid further losses. This reaction is understandable, and there may be times when selling seems like the best choice. But investing means coming to terms with the ups and downs along the way. Most people are naturally more afraid of losing money than excited about making it, which is normal since it takes hard work to earn, and no one wants to lose it to forces they can't control. That's the nature of the game when investing. So, moving on, let's dive into some investment theory. This will help investors manage their risk effectively, especially if they're feeling uncertain about recent market events. Here are 3 key factors to consider. The first factor is understanding the original goal behind the investment. Knowing why someone is investing is critical. It's not just a vague ideal, but an essential guiding principle. Is the investment for early retirement, to fund a child's education, or something else? For instance, if it's for school fees, then it's important to ask, how old is the child now? And when will these funds actually be needed? This naturally ties into the next factor, time. Time and goals are closely linked, since knowing when the funds will be needed helps in setting a clear financial target, like determining exactly how much is required per school term. Whether the goal is $5,000, $7,000, or $15,000 a term, having these specifics helps outline how much needs to be invested and the kind of returns needed to reach that target. Ultimately, the timeline for reaching this goal will directly influence the level of risk in the investment strategy. This crucial link between time and risk is often overlooked, especially on social media, where discussions about investing rarely include such details. That's why these insights are valuable, as they form the foundation of professional investing advice to ensure people are set up for long-term success. The core purpose of investing is to align investments with the goals, timeline, and risk tolerance. The third factor is risk tolerance, which is twofold: willingness and ability to take on risk. Willingness to take risk is subjective. For example, on a scale of 1 to 10, someone might rate themselves as an 8. But ability to take risk involves practical considerations of personal finances, like having control over one's budget, any existing debt, and the presence of an emergency fund. An emergency fund can provide a cushion, allowing investments to ride out market fluctuations without needing to withdraw money unexpectedly. These are all essential factors for an investor to weigh carefully. The risk someone can take with their investments often depends on their situation, and this can influence the actual risk level they go with. A general rule of thumb is that the more time available before needing the investment, the more risk that can typically be handled. With less time, like a horizon under 5 years, high-risk investing might not be suitable, and if investing is still chosen, it should likely stay on the safer side. But with a longer time frame, say 10 to 15 years, such as saving for a child's future education, there's more room to take on risk. Matching investment choices to personal goals, timelines, and risk tolerance is crucial. While newer investors might not usually think of it this way, it's worth taking the time to go back, review the portfolio, and reflect on why they started investing in the first place. Instead of picking a timeline based on social media advice, the focus should be on personal needs, whether the target is 5, 10, or even 15 years away. Having a goal is essential because it sets the course for how the money is invested and determines the level of risk involved from the start. Sometimes, even with a plan, investors may feel uncomfortable or uncertain, which is normal. If cashing out is what feels right, that's okay too, even if it means taking a loss. It's vital that each investor feels confident in their choices. This kind of flexibility is necessary because life circumstances can change, which means investment plans might need a reset now and then. Adjusting the portfolio is a healthy part of the process, ensuring it goes with current needs and provides a sense of comfort. For some, having funds they'll need soon means making timely adjustments. Like when a portion of the investment matures in a specific year, some investors may choose to cash in a bit early if they need the money. Reviewing the initial strategy and reevaluating can be smart moves, and there's no harm in changing course to make things more practical or secure. Experienced investors often revisit and adjust their goals, timelines, and risk tolerance over time. Investment plans are fluid and may shift as situations evolve. What's true on day 1 isn't necessarily right by day 3432. Plans should adapt as goals and timelines shift, keeping things relevant. Finally, it's important not to panic. Markets are cyclical, and this phase will eventually pass. Avoid the sensationalism from some doom and gloom commentators. Remember the reasons for investing in the first place and keep these key principles in mind. This approach offers a solid foundation, providing confidence and clarity. What's your biggest challenge when it comes to investing? Risk, timing, or sticking to your goals? Drop your thoughts in the comments. We'd love to hear from you. And if you found value in this, consider hitting the subscribe button so you don't miss out on future tips. Thanks for watching, and see you in the next one.